Facebook stock price crashed 75% in 2022. It then did a 5x. Snapchat crashed 90% and never recovered. Like Facebook, can Snapchat turn around or does it deserve to stay down? In this video, we'll find out. Hi guys, welcome back to the channel. If you're new here, I'm Bilal, valuation expert and professor of finance. On this channel, we talk about valuation, AI, and entrepreneurship. Now let's dive into Snap's stock analysis. Alright, so let's dive into the analysis of Snap Inc. Snapchat is a social media company. Their key innovation was that users could send photos to their friends, family, and those photos would then disappear. They were founded in 2011, and just 2 years later, they got a $3 billion acquisition offer from Facebook. Now let's look at their stock performance. So they listed in 2017 at around $25 per share. The stock didn't perform too well until the pandemic, when everyone was locked at home and everyone was online. But then post-pandemic, because of high inflation, the Federal Reserve started hiking interest rates, and most technology companies were affected as a result. Snapchat's stock price crashed 90% since then and has remained down ever since. How do we analyze a stock? I like to follow what Bill Miller says. The first duty of the investor is to figure out what is embedded in the stock price. So another way to put that is to ask yourself, what is priced into the current stock price? Or what are the expectations investors have built into this current stock price? Typically, what's priced in a stock is its future cash flows, as well as the discount rate, or what we call the weighted average cost of capital. When you combine those two things, you get basically a discounted cash flow that results in the stock price. So we have to work backwards and figure out what's in the discounted cash flow. So for Snapchat, the starting point is the stock price of $7.91 per share, which is a valuation of around $13.5 billion. We know that the discount rate is 9.5% based on market inputs, and I have disclosed the market inputs that I've used here. Next, we need to look at the future cash flows, and so I've built a DCF model here, and the initial years of revenue and EBITDA I was able to look at the average of the different analysts who cover the stock to get that as a starting point, and then the rest of the years I then model out to sort of try to work back to the 7.91. It's hard to visualize it in this table, so I have then done it in charts. By the way, if you're enjoying this and want to learn how to do this exact analysis yourself using smart templates and AI tools, I run a 5-week hands-on AI-powered valuation program. You'll get all my tools and templates, work on real cases, get expert feedback, and walk away with practical skills that you can use immediately and even charge for. The link is in the description. Now back to the analysis. The investors or the market is expecting Snapchat to grow from $5 billion in FY24 to around $12.7 billion. So this is a CAGR of around 14% for the next 10 years. Historically, the last 5 years CAGR or the last 4 years CAGR have been around 28% to grow from $2.5 billion to $5.3 billion. In terms of gross margin, they stabilized around 54%, but the investors have priced in them to achieve a 68% gross margin by FY34, and accordingly their EBITDA margin is priced in to rise from negative in FY24 to 29% by FY34. This is quite an aggressive increase in profitability over the next 10 years. Historically, they were loss-making. They still expect it to be loss-making. The analysts expect them to be loss-making over the next 2 years and then break even from FY27 onwards. In terms of working capital and capex, not very material for this company, so we're not going to spend too much of time. So now that we know what cash flows are priced in to achieve this stock price or this $13.5 billion valuation, the next thing that you need to do is analyze or assess these expectations and to see whether you agree with it. If you agree with it, then you could argue that the 7.91 is a fair price. If you think that this is too conservative and you believe Snapchat can outperform, then you would say that this stock price is undervalued. Or if you believe that these forecasts are too aggressive, like I do, then you would say that this share price is overvalued. The way that I would do this is I would look at what's Snapchat's key performance indicators and how we expect those to perform, their revenue breakdown, their products, services, and geography. Like a typical social media company, majority of their revenue is from advertising. Looking at their daily active users, this is the main KPI for a social media business. Historically, their user base has been mainly from America and Europe, and that's where the growth came from. But over the last couple of years, since 2020, majority of their growth in users have been coming from the rest of the world, while the US and Europe have sort of stabilized and the growth rate has sort of come down there. In terms of average revenue per user, this is a key indicator for a social media company. If you look at the blue, which is the US, the most profitable customers, or the high value customers, are from the US, next is Europe, and the rest of the world is last. If you look at the daily active users for the forecast now, as you see, majority of the growth is coming from the rest of the world, whereas Europe and US have somewhat stabilized. Europe overtakes US, but as we saw earlier, the average revenue for a user from the rest of the world is significantly lower, so you need a lot of these users to compensate. Revenue growth, as you saw, is driven by the rest of the world. Maybe Snapchat would be able to scale up globally. Perhaps they would be able to achieve these revenue numbers. But my concern is on the gross margin. Whether they haven't historically hit 68%, and whether they can actually improve this to 68% is I'm somewhat skeptical on this, and accordingly their EBITDA margin, whether they can actually, the GP margin feeds into this, but also whether they would be able to reduce their spend on R&D as well as marketing costs. But I think that that's unlikely, because they need to stay competitive with the other platforms, so they would need to continue investing in R&D as well as marketing to scale up globally. So whether they can actually achieve a 29% EBITDA margin is what I'm skeptical about, and I think that the investors or the analysts or the market is pricing in a very, very optimistic outlook for this business. And then when we look at the EBITDA margin that they want to achieve, 29%, in relation to mature companies like Facebook and Google, 29% is high relative to these monopolies or these market leaders. Whether they can achieve 29%, again, I'm a bit skeptical when I look at the profitability of a company like Google, 33%. The 29% seems high for me. In terms of the valuation multiple that the market is giving them, as you can see, based on their current valuation of $13.5 billion, it's about 2.8 times revenue, which is on the low end compared to the comparable companies. Reddit is priced at 9.5 because it's expected to have really high growth. Meta, 7.6 times because of the high profitability margins, and Google in the middle here at 4.7 times. So in conclusion, I think I can basically say that this is a stock that I believe is priced to perfection for them to grow their revenue to hit those EBITDA targets over the next 10 years. I think that they would have to have flawless execution, and I think the market is just pricing in all of that too perfectly. I think that this is a stock that is overvalued. Having said that, they do have some upside if interest rates come down, because at the end of the day, when interest rates come down, the discount rate comes down and valuation pops a bit. But anyways, that's my analysis, and I hope you enjoyed it. If you like this analysis, don't forget to like and subscribe. I post weekly valuation breakdowns, and if you want to learn how to do this exact analysis yourself, I run a 5-week hands-on AI-powered valuation program. The link is in the description.